Welcome back. We are still tracking results, banking results in the first quarter. So far, both public and private sector have largely been above market estimates. ICICI at one end has, of course, been exceptional, while Axis Bank disappointed with higher slippages, albeit technical, they called it. But are the numbers all priced in? And how will the rest of the year pan out? Joining me, Santanu Chakrabarti, India Analyst BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much indeed for joining us. Your best pick is HDFC Bank. I would have thought, going by the results, ICICI Bank with margins, which is about 70 basis points higher than HDFC Bank's, would steal the cake. But anyway, let's go one by one. HDFC Bank, what makes you so confident that the mean will revert and they will come back to that near 4% margins?
Right. Good morning, Latha. First of all, it's a pleasure to be here. And you're right. I mean, if I have to name a leader in the entire banking pack today, I think the baton has arguably changed hands from HDFC to ICICI a while back. Some of it may not be within HDFC's control. After all, when you get a full, large wholesale liability franchise merged into you, your liability strengths on a percentage basis do not remain what they were. My argument in HDFC Bank rests on the simple premise that there are certain new realities with the new balance sheet, which is basically that fundamentally this is now going to be a lower margin business. But at the same time, thanks to the scale that comes in, it is also going to be a lower operating cost business. And finally, within the next 2 years, you will see exit ROAs and ROEs converge with its pre-merger levels of 2% and 17% respectively, which should drive the full re-rating. In fact, the anticipation of the same or visibility of the same should be enough to drive the re-rating back to something, if not the older multiples, something fairly north of where things stand today.
Okay. Having said that's very important. Yeah, sorry, go ahead. Sorry.
I said that having said that, I have, no reservation in calling out that as of today, on landed cost of liabilities, even adjusted for scale and operating cost, etc., ICICI has a clear edge over everybody else. It has the greatest privilege in banking, which is the ability to pick and choose the risks that you want because you have a cost edge. As far as HDFC Bank's results go, frankly, Latha, I think post the results, markets have probably treated the bank stock a little better than I would have expected it to. Because on margins, just you were pointing out, ICICI's margin performance. Quarter on quarter, the dip for HDFC Bank was a little sharper than most people expected, right? I mean, it's not a deal breaker in terms of a long-term thesis, but the immediate reaction being positive despite that is something which is quite interesting.
Okay. No, I agree with you. I think everyone is believing what you are saying, that even if the margins don't come back to the 4% plus, they will manage on ROE because of other reasons. But even the ROE is about 14.5, isn't it?
Right.
Compared to, I think, ICICI 16 plus, almost 17. So by when do you think HDFC Bank gets to its old ROE? Is that happening end FY26, exit of this year? Is it happening exit FY27?
Right. So, Latha, to answer that question, the first thing we have to keep in mind is the amount of legacy liabilities which are high cost, which they have inherited from their erstwhile parent. This comes in two primary sources. One is the non-convertible debentures, which HDFC had issued. On that, the expiry schedule is available with us. And therefore, we know we have about 1,90,000 crore kind of numbers still outstanding at about 8%. And similarly, there's, of course, term deposits, which have been grandfathered in from the erstwhile parent, which would also be typically at 50 basis point, 25 to 50 basis point higher costs than what HDFC's equivalent cohort would be. So both of these, I think the expiry schedule on both of these ensures that on a secular basis over the next 7-8 quarters, each quarter HDFC Bank has an incremental tailwind of 2-3 basis points building up sequentially every quarter on margins. Now, that may not sound like much on a per quarter basis, But if you add up, it adds up to almost 15 to 20 basis point of margin tailwind over a 2-year period. Now, other than that, there are, of course, cyclical factors at play. Please understand that if I calculate CASA as a percentage of total liabilities instead of deposits, HDFC Bank's CASA today is below 30%, right? So, and of course, there's a CASA engine out there, which even though in the last year has been outshone by ICICI Bank, in the 3 previous years before that has done a fantastic job of shoring up whatever little was available in the system. So from that point of view, as the easing continues and low-cost funds become more and more available, HDFC Bank should be in a good position to take advantage of that. And I think in management commentary also, you can see allusions to that factor. When management is saying that, that we are basically now willing to accelerate in the first stage, bringing it to 95% credit deposit ratio and mobilizing money was the key, while now we become more selective, more aggressive, better cross-sell to clients and so on and so forth. Now, obviously, they have the machinery to get that done. So I think, they remain a very counterintuitive beneficiary of easing, even though they are 70% floating rate assets.
Okay. Yeah, we are forgetting that even if you look on a year-on-year basis, that stock has given about 15% returns. It was around 1,700 same time last year. So it's a fairly decent return in terms of stock price as well. Obviously, most people believing what you are saying, that the ROE will come in good time. Now, I have a more general question before I delve into the specific of Axis and ICICI. Do you think that the banking system or banking investors are not prepared for a much lower credit growth? The credit growth numbers, fortnightly numbers, are still single digit. Now, is it likely to remain that way for the rest of the year, given that credit offtake is... most bankers are telling you credit offtake is not happening.
So, Latha, the way I look at this is that whether any future rate cuts pan out or not, simply from the amount of liquidity available and the soft indicators that RBI is putting out, the subtle change in tone that you see in commentary of the banks, where they are saying, we are well poised for growth, etc. I think we are at the cusp of a small growth acceleration, but let's keep that in context. I'm not saying that we are going to go back to 17-18% credit growth. I think we exit this financial year with about 13% credit growth, which is still almost 300-350 basis point acceleration over where things stand today. Now, what gives me that hope? This quarter was the last quarter where a high disbursement number was in the base for retail loans. The next 3 quarters of the financial year actually have low disbursement numbers for retail loans, mainly because of the pullback that happened within unsecured loans and credit cards in this corresponding period last year. So I think for the full year, the banking system should be able to deliver 14 to 15% credit growth in retail. Just from normalization, not from going back to the gung-ho days of 25 to 30% growth in, personal loans. I'm just talking of a normalization. We, of course, remain constructive on the SME sector, and their 17 to 19% kind of growth seems to be holding on very well. The only laggard is going to be the corporate sector, in our opinion. I'm sure, the 101 arguments can be made as to why, it's just right at the cusp of an acceleration, etc. But I think given where the global macros are, if you talk to most promoters in India, very few people have the appetite to be jumping into large projects with long-term bank financing right now, especially when, a lot of foreign financing in the debt markets is available to them, right? So I think 6-7% corporate loans is what you should be budgeting for the year. But that still gives you a very solid 13%.
Okay.
And since
I agree with your 13% exit, maybe not 13, at least 12, but the average for the year could still be single digit is what everyone, every banker after banker tells me, we have money, but whom do we lend it to? That seems to be their problem. But anyway, we are running out of time. Axis, is this the last of the accidents? This came out of nowhere. would you still, you're still betting the house on Axis. Where does this confidence come from? Even the loan growth has been muted.
Right. So, I mean, Axis has disappointed continuously for the last 4-5 quarters by small measures, which is why the hope has not died, but it has been frustrated again and again and again. So, firstly, let me highlight what are the two things working in its favor. One is, of course, the valuations. If anything's trading at 1.6 times 1 year forward, and it's a 40% CASA bank, which still can do mid-teens ROE, without huffing and puffing too much in terms of what risks it takes, it looks like good risk reward. Second is on the liability side, given the degree of short-term funding that they have available, they remain one of the early responders on cost of funds as far as an easing cycle is concerned. That's what's working in its favor. What's not working in its favor is ever since the merger and having digested the merger, in the last, especially in the second half of the last financial year and this year, headline growth numbers, whether they be on deposits, on loans, on low-cost deposits, that is CASA, it's been a bit of a disappointment. And there's just no squaring that circle. Even on credit costs, I will take you back to first quarter of the last financial year when the first spike happened. And they had, they didn't call it technical, but they said specific assets, we had to do some recognition. And, large part of it, they implied that it's going to get clawed back. But adjusted for, what happened with NARCL in the last quarter, where they got a release purely because of, change in regulation.
Yeah.
Otherwise, the true credit costs have averaged at about 83 to 85 basis points, right? Which is significantly higher than where the other large banks are posting. And they are talking of a retail asset cycle in a period where others see it normalizing, the minor cycle we have had in the last year. So, yeah, it's been frustrating, but I still think it is one of the better options for beta. Is it as at high in our pecking order as HDFC and ICICI? No. But it is one of the smarter beta plays, especially in a situation where, IndusInd Bank in itself is a harder buy for most people, given, the uncertainties around the name.
Okay. Yeah, if one is perhaps looking at a beta, then maybe Axis has a better chance, but still you are looking at an almost 45% jump from the current 1,100 rupees to, 1,600 plus, which is your target. Right. That looked ambitious to me. Actually, I have more questions for you in terms of the MSME loans, but out of time on another day. Shantanu, thank you very much for joining me to analyze the results of the big banks that have reported so far. There are many more to come, especially the big SBI. We'll analyze that as and when. For the moment, a short break and then Chartbust.